$150 billion. In the bond market, money doesn't scream. It evaporates. It leaves a negative space so large you only notice it when the floor tilts. $150 billion is not a trade. It's a migration. A convoy pulling out at night with the headlights off. The moment you announce you're leaving, you become the reason the door narrows. People think the US bond market is a chart. It isn't. It's plumbing. It's collateral. It's the floor under every other asset. Mortgages, corporate debt, equities, pensions. You rent your house from the interest rate. When the biggest buyer walks away, the price of money changes. And when that changes, the price of your life changes too. The real money was repositioning. It was exiting duration, pulling back from long promises toward short certainty. The bond market breaks from a missing bid, from a buyer who used to show up like gravity and suddenly doesn't. What happens when the biggest buyer walks away at the exact moment the seller needs to sell more than ever? The US rolls its debt. It keeps the game going by refinancing yesterday's chips with tomorrow's chips. Now yields have risen. Suddenly the interest became a predator with a monthly appetite. Japan loved the trade. Borrow cheap in yen, buy higher yielding dollars. It was the carry trade that funded decades of calm. But when volatility rises, hedges get expensive. That's when a rational adjustment starts to look like an escape. Repo is the heartbeat of Wall Street. If the collateral is questioned, the heartbeat becomes arrhythmia. Think of repo like a pawn shop for the financial elite. If Treasury prices drop, the pawn shop demands more collateral. To understand where this ends, we have to look at 1971. The world shifted from money anchored to gold to confidence. There's another historical receipt. Rome. Empires collapse when their money stops being believed as the neutral unit. The unprepared person hears bond market and thinks it's abstract. They mistake normal for guaranteed. History doesn't repeat, but it rhymes. Subscribe to see the pattern.